Good evening, everyone. Time for another silver update. This is the weekly platinum chart provided by netdania.com. You can click on the link below. This is actually an overlay of platinum and palladium. The blue line chart on the left here is palladium, and the bar chart on the right over here is platinum. The reason I brought this chart up is because we've had a very rapid move recently. You can't see it in perspective because this is such a long range chart, but we've had a very large move in platinum from about 1550 all the way above 1700 in the last week or so. Palladium has not followed. Now, these are very interesting metals. These are members of the palladium group, the platinum group. And there's four metals in this group: platinum, palladium, rhodium. I don't remember the fourth one, but they all have a similar function that they're used in industry. They are able to absorb roughly 4 times their weight in carbon monoxide. So these are metals that are used in the catalytic converter, and you can see we had a very dramatic rise around 2000, starting in about 1998. If we go back to about late 97, early 98, you can see that palladium was around $200 and platinum was around $400, so about a 2-to-1 ratio. We had an explosion in the palladium price all the way up to almost $1,100 an ounce, while platinum was only about $650 an ounce, almost a 2-to-1 ratio. And then we had a big, huge change when we got the move where platinum surpassed palladium relatively. So platinum began to rise as palladium crashed down, and we ultimately got a spike of about $2,300 in platinum, while palladium was only at about $564. So at this point, palladium was almost twofold the price of platinum, and at this point, platinum was almost fourfold the price of palladium. So both of these metals are able to be used in catalytic converters. They perform the same function, and this rise here, the news stories from the time talk about the hedging that Ford did, and I believe Ford lost roughly $2 or $3 billion in this collapse because Ford was trying to stockpile a bunch of the metal. And so the comparative prices of these two metals are very interesting. Now, if you look in the recent history, you can see that these two metals are really have started trading closely, almost in lockstep, and then we get to the point where platinum is starting to gain very rapidly while palladium is really not catching up. So the question is, what is the news story that has caused so much movement in platinum and palladium's not really following up? We don't know. Speculation could be that platinum is starting to become accumulated as a type of third precious metal or some type of inflation hedge. I can't really say at this point, but it's a very interesting chart. Now, if we go over to the gold chart, we had a very dramatic move today. Zero Hedge did an article about the 1776 price, and you can see if we pull in closer, we had a very large spike once gold got through that 1760 price. It really just ran very hard, and it has pulled back, but it's pulled back in kind of a pennant, a minor pennant. So gold seems to have broken out significantly. Now silver is still lagging relatively to the gold price. I put up a chart on my blog comparing the gold and silver price, and as you know, if you followed silver as long as I have, that silver tends to lag gold until it doesn't, and then when it doesn't, let's get to the daily. It's very dramatic. So in this move here that silver made, this is the beginning of QE2 at the end of 2010. This is when silver really began its run. At this point, silver actually caught gold and outran it. So the question is silver going to do the same thing today? And you saw the chart of gold. Gold is very, very close in dollars, also in euros, to being about 96% within an all-time high. You can see that silver is nowhere near that price. Around 34, all-time high is around 49.50, which is the price that we hit back in 1979, the nominal price, and it's what we hit before the May smackdown. So hopefully silver is going to follow gold and catch up and then surpass it. It wouldn't be surprising at all for us to go past that 50 price very rapidly if that occurs. The last chart is the oil chart. We've been following this very carefully. The oil is still rallying. It's not showing much weakness at all, and it has to get through this 115 price, and that would be a very ominous signal. Now I want to take you over to the blog real quick and cover a couple of things here. On the left hand side of the blog, I've added a news feed. This is a news feed that is generated based on the keyword of the article you're in. The general blog keyword is going to be bullion, so that's what you're going to pull here. But if you go into the key news stories, this is a story I'm going to talk about a little bit here in a bit, is the Volcker rule. This is covered by Russia Today. But if we jump in and click the article itself, you can see the keyword is the SEC, and you can see the Google News feed on the left-hand side is pulling the relevant articles that have fed through the news channel relative to the SEC as a keyword. So if you want to get some of the keywords on the blog, you need to click into the article and then it will trigger that keyword. Now I want to talk about this article or this interview here with these two ladies who are former insiders. This gal on the right here, I believe she's former Morgan Stanley. She's actually with a number of Wall Street companies, and this other gal as well, and they're talking about the implementation of this Volcker rule and what impact it's going to have. So I want to look at that Volcker rule real quick. If you remember Paul Volcker, he was the Federal Reserve Chairman under Reagan under his first term. Now, if you watched Chris Duane's latest video on the Hunt brothers, you remember that it was ultimately the implementation of the very, very high interest rates, both short and long term. I think both the 1 and 90-day Treasury and the 1-year note, as well as the 30-year bond, came very close to 20% interest rates back in the early 80s when Volcker decided to crush the inflation. So that was key in bringing down the Hunt brothers scheme, which was not to corner the silver market, but to remonetize silver in a way. If you look into Chris Duane's video, you'll see how they worked with Marcos and with various Arab powers to try to make silver remonetize silver and make it a currency again. And of course that colossally failed. But I think the key is that there was too much silver at that time, and also, of course, the Fed was willing to raise rates to a ridiculous level to stop inflation. Now, just to put that in perspective for today, you know that we have roughly a $16 trillion debt for the United States, and if we implemented 20% interest rates that they need to refinance that debt at, you're talking about 1/5 of $16 trillion, so we'll just say $3 trillion roughly, and we know we take in tax revenues of about $2.2 trillion a year. So if our interest payments were $3 trillion and we take in $2.2 trillion in revenues, obviously were completely bankrupt at that point. So it's not likely that this Volcker situation will repeat as far as the Fed. But this rule here is the Volcker rule, and this is about implementation of separation between the accounts on the banks where they can speculate as to futures transactions and other transactions to try to make a profit, but this rule says that they can't use customer funds. So I wanted to examine that a little bit deeper because a lot of people are banking on this as if this is going to be a big solution, and I'm going to show you why I don't think that's going to be the case. Excuse me. So I'm going to take you to a video where we're going to watch Representative Kaczorski, where he's talking about what happened in the 2008 financial crisis. This is a crisis where we had a run on the money market funds. Now, this new Volcker rule is only talking about segregation of banks' depositor cash from speculative cash. So I want to take you over to that Kaczorski interview where he talks about what actually happened in the fall of 2008.
So what would you say, though, then, to somebody who says Paul Kaczorski is supporting Wall Street but not Main Street with this latest $825 billion package now moving through the House?
They are right to this extent. Why did we do that? We did that because the Secretary... Look, I was there when the Secretary and the Chairman of the Federal Reserve came those days and talked with members of Congress about what was going on. It was about September 15th. Here's the facts, and we don't even talk about these things. On Thursday at about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours the world economy would have collapsed. Now, we talked at that time.
Okay, so the point is that Kaczorski is pointing out that there wasn't just a run on the banks. There's actually a run on the money market funds, and the entire system was imploding at that time. Now, I would love to entertain the thought that some type of new rule, like the Volcker rule, which segregates the accounts of the banks, and that would do something to stop the too big to fail idea. If you look into this Wikipedia article, it says Volcker was appointed by Barack Obama as the chair of the President's Economic Recovery Advisory Board on February 6, 2009. President Obama created the board to advise the Obama administration on economic recovery matters. And it goes into the idea that this would stop this too big to fail problem. Now, the problem with this idea is that this supposes that too big to fail is a particular bank. But my contention is that too big to fail is already larger than any particular banking institution. As we saw from the Kaczorski interview, there was a run that would have potentially reached $6 trillion on the money market funds. That was basically a break the buck scenario where money market funds, which are always required to return 1 to 1, would actually return less than 1 to 1. So this was a complete collapse of the financial system. This is not a matter of segregating banks. This is a matter of this entire system collapsing upon itself. So although I think that the Volcker rule is a good idea, I think that the horse is too far out of the barn at this point, and that this rule really couldn't stem the type of financial collapse that we're talking about. The type of financial collapse we're talking about, which nearly occurred in 2008, would have been a collapse in the money market funds, which is the shortest term notes, as well as the stock market, the bond market, certain sectors of the commodities markets, certain foreign currencies. So what you would have seen was a collapse of the paper system of interconnecting debt obligations, and all of these are interconnected. So my contention is that it's too far, it's gone too far. If Bank of America collapsed today, it wouldn't just take down Bank of America. It's not a matter of Bank of America going under and then the government could come in and guarantee to $250,000 the savings deposits of the people. It wasn't a matter of the savings deposits being wiped out. It was a matter of the retirement accounts, the pension funds, the 401ks, the money market funds, and all of these funds would have been wiped out to zero, and you would have had all of the retirees in the United States, including the federal retirees and the 401k pensioners, and probably even Social Security and everything else would have collapsed at the same time. So I'm not trying to justify what these people did in 2008, but I am saying that the Volcker rule is far too optimistic. It is an attempt to just save one tiny part of this over-leveraged system. And I think if you look at the gold price here, you can see that this is a bet that the entire paper financial system is at risk, not just portions of it. And I think that the next time that we have this crisis, it's really not going to matter whether a Volcker rule is in effect. You're going to see a collapse of the entire financial system, which means that every debt obligation, piece of paper instrument where a person says they owe somebody something and they're going to pay that, I think all of these obligations will be reneged upon at the same time, and there simply isn't a rule that can deal with all of this. It's the entire system that is too big to fail, that it is the system that they bailed out, and that ultimately it's going to be the entire system that collapses all at the same time. And when that happens, you're going to have physical silver and gold. And we'll talk to you next time.